Mohamed, I give you credit. You know, you've been pretty optimistic about the U.S. economy for a while, even when we were in the depths of that stock drawdown at the end of last year. Do you still see the U.S. continuing to outgrow the world and fueling this market?
Very much so in terms of the U.S. continuing to outgrow the world. And this theme of divergence is the right one. It's not about a synchronized slowdown, it's about divergence. But for the marketplace, remember how sensitive corporate revenues and profits are to the rest of the world. So the relationship with the markets is not as strong as the relationship just in terms of the economics of it.
In other words, we're bracing for an earnings season. You think that there's going to be some negative surprises, especially on the multinational front?
Yeah, I think I think we're going to hear a lot about a couple of things. One is weakness abroad, particularly in Europe. Europe is slowing much more than people expected. Secondly, we're going to hear about risk aversion, how there is an extra element of risk aversion as consumers pull back in the rest of the world. So I think you're going to see the companies that are sensitive to the outside world being much more cautious about the outlook than they've been so far.
The Barron's cover this weekend, Mohamed, is the bull unstoppable. What does that mean to you? Is that sort of an uh-oh sign that's a contrarian indicator?
So last week was significant because we saw somewhat better data in Europe, but not that much better, but better data out of China. And you saw what the market did. It loved the fact that you could get a handoff from liquidity, central banks, to fundamentals. So if you're a bull, it's because you assume that that handoff is going to occur. I think that handoff is going to be a little bit more problematic than what was assumed last week. But you can see why people are optimistic. They like the fact that China is stabilizing, and they're hoping that Europe will stabilize.
Mohamed, it does feel like we've gotten a lot of sort of recession false alarms. How should we read the latest jobs report? Another very solid number, some wage growth, unemployment rate stays near a half-a-century low. What does that tell us about where we're going?
So it tells you the labor market remains very strong. It tells you the consumer is going to continue to power this economy about 2.5% to 3%. That's what the disappointing part about last week's employment report wasn't as much wage growth, which a lot of people focused on. It was the fall in the labor participation rate. What we really need is better demand and better supply. We're getting the demand side. The supply side is not responding as much. So keep an eye on labor participation. That's going to be key going forward.
Sort of takes us to this conversation we don't usually get to in our era, Mohamed, about immigration, though. President over the weekend says the country is full. And given our demographics, others argue that you need to double, triple legal immigration, at least, to give us that labor force that we can't seem to find.
Yeah, we have this strange situation called that, where vacancies are about 1 million above those who have registered to be unemployed. So if you can't bring people in, if you have a skill mismatch, legal immigration can be part of the solution. So it should be discussed in terms of the economics as well as the social. But that issue is being obfuscated right now by what's happening on the border, by issues about illegal immigration. But there's no doubt that if you look around the world, legal migration can help your growth potential.
I wanted to ask about the Fed. I mean, this is really big news. It's gone mainstream. John Oliver tackled this issue yesterday. Herman Cain, Stephen Moore, potential nominees from the White House to be on the Federal Reserve Board of Governors. And just to be clear, getting a vote at every single meeting. So Herman Cain, he's had some experience, Kansas City Fed Board. He ran a business. But I think what's most worrisome here to critics is that he had a PAC whose goal was to carry out national messaging and public relationship campaigning to facilitate and grow a national grassroots movement of educated and informed voters to engage and fight for the president's policies. Is that problematic?
So there's two issues here, Sarah, and I think it's important to focus on both, and the markets hasn't yet. And we can talk why people are so relaxed about it. One is this notion of political interference with the Fed. That is not good news. The second is what set of experience and expertise do you want on the Fed? And what they're missing most, I think, is what President Trump called the feel for the market. People who have a good feel for the market. And neither of the nominees brings that. So these are the two issues. But I can tell you that the markets so far are really relaxed. They shouldn't be, but they're really relaxed about this issue.
Why do you think that is?
I think they're relaxed for a couple of reasons. One is they don't think inflation is a problem, so they don't think that interfering with central bank independence is an issue. Second, this sort of interference is good for them because the political process is asking the Fed to put in more liquidity, cut interest rates by 50 basis points, restart QE. That's music in the short term to the market's ear. So I think they're not focusing on it, but they should, because longer term, this can be an issue.
I mean, where would you expect to see that show up? Is that an issue for the bond market?
It depends how these nominations proceed. But if they are successful, I think you're going to see the marketplace worry over the longer term profile of inflation, over the consistency of two things that the Fed minutes actually may help us this week. One is inflation targeting consistent with financial stability? And that's really important, given that there are these disinflationary forces on the economy. And second, as important, is how does the Fed navigate domestic strength with international weakness? That's not an easy thing to navigate, and we've seen the flip-flop, the 180-degree turns of the Fed in the last 6 months. That's not good for credibility.
Hey, Mohamed, you mentioned markets being relaxed. Where's your head right now on leveraged finance? Washington Post has a piece today about the administration and lack of apparent answers as to what they might respond or how they might respond to a crisis in leveraged loans. Could it come up on Wednesday with the Fed? And in general, is it a huge liability for equities?
So the liability is that the risk that we used to, which is in the banking system, has morphed and migrated to non-banks. And it's all over the place, but not at a critical mass. You just mentioned leveraged loans. I'll tell you, look at some ETFs. The industry has offered ETFs which promise, Carl, instantaneous liquidity at reasonable bid offer. That's what an ETF signals to the investor. And they've been offered on inherently illiquid asset classes. So we see these pockets of excesses, and they are outside what the regulators have been focusing on so far. So the one thing to worry about for equities is that you get a critical mass in terms of a number of these. We haven't had that yet, and I think we're not there yet, but it's certainly something to keep an eye on.
There's a little debate this morning, Mohamed, about the trajectory for bond yields for the rest of the year, whether we'll see them head back south again or continue to shoot up from here, and whether the worst of it is over in terms of those low levels. What do you think?
It's all about Europe. I mean, people are trying to explain this in terms of the U.S., and because of that, I think they worry too much about the yield curve and inversions. This is all about Europe. Sarah, the one relationship I always look at is the 10-year Treasury versus the 10-year bond. It's at 250 basis points. Historically, that's really elevated. So if you want to know where our yields are going to be beyond 5 years, look at Europe. And if you think they're going to go up, it's because you think Europe is going to recover. If you think they're going to go down, it's because you think Europe is going to do even worse. It's all about Europe, and people should realize that when you make a U.S. interest rate call, you really are making a European economic call.
Well, they are facing Brexit and, super easy monetary policy, negative interest rates for as far as the eye can see. So what's your forecast there?
So I love the sport analogy when you go to Europe. I mean, would you bet on a team where the 5 main players, your difference makers, are all having problems? You mentioned it, Brexit in the UK. In France, there are protests going on. In Spain, there's an election that's likely to be inconclusive. In Italy, there's political issues. And in Germany, you have a major political transition. Would you bet on a team where the 5 main players are having issues? And in addition to that, there's no teamwork to speak of. The EU is fragmenting in terms of decision making. So I really worry about Europe, and I'll stress again, the market should pay greater attention to the weakness in Europe because it is not turning around in any way. And because of that, I do think that yields are going to stay where they are, if not dip a little bit lower.